Okay, guys, let's take a look here at exercise 119, and once again, this can be found on the in the Word document that I made available to you here in this module of the class. Okay, so it says Universal Services was organized on October 1st, 2012. A summary of the revenue and expense transactions for October follows. Okay, so our fees earned, that's our revenue, right? $800,000. Wages expenses, $270,000, right? So that's for people working for us. The rent expense that we incurred was $60,000. Supplies expense was $9,000, and we had $12,000 of miscellaneous expenses that did not fall into any of these other major categories. We're asked to prepare an income statement for the month ended October 31st. Now keep in mind with the income statement, also known as the profit and loss statement, that covers a period of time. Might be a month, might be a year, but as opposed to the balance sheet, which just takes a look at a specific date in time, it's a snapshot at a specific date, the balance sheet is. This here, the purpose of this statement is to be able to see how profitable the company was for a certain period of time. So in this month, how much profit was the company able to generate? So in the profit we're going to see here is the difference between the amount of fees that we earned, our revenue, and it's going to be reduced by all of these expenses that we incurred in pursuit of generating these revenues. So let's take a look at what the answer would look like. Okay, so notice here it's important to have proper form when we put this together. So at the top we have the name of the company. The next thing that we list here is the name of the financial statement. And then it's very important here to specify what period of time. So this says for the month ended October 31st. So this is for the 31 days of October in 2012. The first thing we do is we list out the revenues that we were able to generate. $800,000. Okay, so just because you've generated revenue, it's a good thing that you're generating revenue, but what if the total of our expenses were $900,000? Well, we would have actually lost $100,000 in terms of profitability for that period. In this case, though, we made $800,000, and the total of these four expense categories is $351,000. Okay, so we can see here it took us $351,000 of expenses to generate $800,000 of income. So our net income for this accounting period of October 31st was $449,000. Okay? Okay, let's take a look at problem 1-2A. Okay, so we're given some information here, and you can't see it. It's just below where I'm filming on my screen here, but it asks us to prepare an income statement, a statement of retained earnings, and a balance sheet, all ending on December 31st, 2012. Okay, so it says here, following are the amounts of assets, liabilities of New World Travel Agency, December 31st, 2012. The end of the current year, and its revenue and expenses for the year. The retained earnings was $105,000 at the beginning of the year. Okay, and during the current year, $10,000 of dividends were paid. And notice here one little thing I just added in here. We're going to assume this $15,000 of capital stock. Let's just assume, to make this a little more simple, let's just assume that that was part of the beginning balances as well. That they didn't issue that stock necessarily this period, but that it just already existed. Okay, it was from a previous period, just the same way we already had $105,000 of retained earnings. Okay, now let's take a look at how we would work this. Okay, guys, so based on the account balances we're given, we see here that we earned $200,000 of revenue. Okay, New World Travel Agency, we have the name of the financial statement, and we have here that it's for the year ended December 31st. So this means it's for the year ended in December 31st. So it's for the entire year. It's a period of time. We list our wage expenses, we list our rent expenses, we list our utilities expense, our supplies expense, and our miscellaneous expense. Okay, and notice here at this point in the game we're listing everything based on the dollar size of the amount. That's okay to do it that way. We subtotal all of these expenses together and we're looking at total expenses of $160,000. Okay, so we generated $200,000 of revenue. It took us $160,000 of expense to generate that. So we're looking at net income for this accounting period of $40,000. Okay, and once we've established what our net income number is in the accounting world, we underline that twice. I don't know if you can see that here on the screen. Hopefully you can, but it's double underlined. Okay, so now this amount, this $40,000, we're not through with it yet. We're going to bring it down here, and it's going to appear here on the statement of retained earnings. Okay, for the year ended December 31st, 2012. So this is also covering a period of time. We have the name, we have the title of the financial statement, and remember it told us that we started out with $105,000 of retained earnings. So this is essentially net income from prior periods. Okay, so it's the earning, it's the increase in equity that we had from activities in prior periods. Okay, and during this year we had $40,000 right here. $40,000 of net income. It tells us in the example that we paid dividends of $10,000. Okay, so remember those dividends, that's a distribution of the earnings of the company, the retained earnings to the owners. It's not an expense. So $40,000 of net income reduced by this $10,000 gives us $30,000. So we started out with $105,000 of retained earnings. Our retained earnings were increased by $30,000 as a result of the activities this accounting period. So that means we have $135,000 of retained earnings at the end of this period once we prepare this statement. Now at this point in time we're going to use this figure in just the same way the net income figure made its way from the income statement to the statement of retained earnings. We're going to use this $135,000 of retained earnings, and it's going to find its way onto the balance sheet. Okay, so let's take a look here. This 135, here's where it ends up. Let's come back to that in a second though. First off, we're told that we have cash of $110,000. We have accounts receivable of $60,000, and we have supplies of $5,000. Okay, these are all our assets here. The total of all those, if we added them up, equals $175,000. Now remember, the accounting equation states that assets equals liabilities plus stockholders' equity. And we're going to see that that's true here, and that is the form of the balance sheet. Okay, notice here we have it labeled what it is, we have the name of the company, and this is of a specific date, a snapshot on this date. If we were to look at what all the account balances were at that specific point in time, not for a period of time, but just for this specific date, this is what it would look like. So we have $175,000 of assets, and of course over here the total of our equity and liabilities combined is also $175,000. If it was not, we would not be in balance, would we? Okay, so from the information given, we see that we have accounts payable of $25,000. We have capital stock, which we were given as well, right? We're just assuming this was a beginning balance of $15,000. Our retained earnings of $135,000 that we calculated up here when we created the statement of retained earnings is pulled in over here. So it shows up, the retained earnings amount that we calculated there is plugged into this balance sheet right here. So the total of $135,000 of retained earnings and $15,000 gives us our total equity of $150,000. And remember, it's important to be able to differentiate between what part of equity is for stock and what part is for retained earnings. We add that $150,000 to the $25,000 total liabilities, and we're looking at $175,000. Okay, so that's how we stayed in balance.